Good afternoon. Just going to discuss investment properties this afternoon, more specifically gearing, what your strategy should look like. Should you negative gear, should you positive gear, how the two work, and which one will benefit you the most. Look, so for those that don't know, we'll start from the very beginning. Negative gearing is all to do with tax, same as positive gearing. So it's basically negative gearing is if you make a loss on your investment property, you're negatively geared. Positively geared is when you're earning money every year on your investment property. That's it. So if you make $50,000 a year, and then your investment property, you get $20,000 a year in rent, and it costs $15,000 to have that investment property, you've profited $5,000. Your taxable income goes from $50,000 to $55,000. On the flip side, with negative gearing, if you lose $5,000, your $50,000 income becomes $45,000. That's all that is. So negative gearing is to reduce your taxable income. The reason people like negative gearing is because you do reduce the amount of tax you have to pay. That is literally all it is. The other thing with negative gearing, with investment properties and things, so you don't have to, not all your deductions are cash deductions, some of them are actually non-cash deductions. So you'll have things like interest on your mortgage, bills, maintenance. You pay cash for those. You physically have to spend the money out of your own bank account to pay for those things. The other thing with negative gearing is depreciation. That's what we call a non-tax deduction. You have what's called a quantity surveyor come through your property. They'll go through and just basically look at the usable life of your house and the things in your house or unit. They then assess over 20 and 40 years how much value those things will lose each year, and you claim whatever the total value they depreciate by every year as an expense, which reduces your income further. We could probably do a full discussion just on depreciation. I'm not the person to do it though, but we may do that down the track. But look, just a really basic introduction to depreciation is that it's an expense that doesn't actually cost you any cash. All right, so that's negative gearing. You're reducing your taxable income. On the flip side, positive gearing. So you've made $5,000 for argument's sake on your investment property. That's positively geared. Your interest, your bills, everything costs you $5,000. You make $10,000 in rent. You are up $5,000 and positively geared. For negative gearing, I don't believe it should be an investment strategy. I just think it needs to be a byproduct of an investment vehicle. So you're buying an investment property, most people for cash flow, or you do it for capital growth over the long term. I'm a big capital growth fan, just because I think in long term, that big sort of cash equity sitting there can be used to further fuel your property growth portfolio. You can pay off your own debts, all that sort of thing. On the flip side, again, cash flow is great as well. Cash every week is really nice. You can't argue with that. Negative gearing though, week to week or every year, you only get back your tax rate on your loss. So if your tax rate is 30% and you lose $100, you get back $30. If you're positively geared though, let's say you make $100, you only pay 30% on that $100. So you're paying $30 but getting left with $70. So with negative gearing, you've got $30 extra. With positive gearing, you've got $70 more, if that can make sense. So while you have to pay tax because you've earned more, your tax rate, you pay less tax than what you get back from negative gearing. So for me, I really think negative gearing is just a byproduct. It's not something you should go in looking for properties, looking for negative gearing. You just take it as an assistance to owning a property. Look, that's it for today's investment property seminar coming up 29th of May. So keep an eye out for the further details on that. And hopefully we'll see you there. Thanks.